Hey, everybody, what's going on? It is James here with Crypto Common Sense, aka Three Peaks Trading. And in tonight's video, we're going to talk more about options, but instead of talking about spread options, we're going to talk about naked options. The reason I call something a naked option is because it's an option with only one leg. I'm not hedged in any way. I will either buy a call option or I will buy a put. It is critical that you understand that I would never, capital letters, never sell a naked option. If you sell a put and you do not have a second leg to hedge it, your risk is essentially whatever the strike price is. So for example, if you're selling a put for $100 strike, you are risking $100 per share because the stock could go to zero and you would lose all of that money times 100 shares per contract. Because the contract is 100 shares. So like a $100 strike would actually be a $10,000 risk. So I would never sell a naked put. I would never sell a naked call because naked calls introduce unlimited risk. Just ask the hedge funds that went bankrupt on GameStop because they had unlimited risk. Imagine for a second that you decide you're going to sell a call for $5 because you think a stock is going to go down in value. Suddenly that stock goes up to $500 per share. You now owe $495 per share times 100 shares times the number of contracts you took out. That's how people go bankrupt. Okay, so I never sell naked contracts or naked options, and most platforms thankfully won't let you do that, but some will, so be careful. But I do buy naked options, and specifically I like buying naked calls. The reason that I like calls is because it allows me to get into a swing long position without needing a stop loss. Let me explain. Here's an example. This is a little clip of a table or a database that I'm building. I told you guys I'm building some software. This is not a pitch for that software. It's not something I plan on selling anytime soon, if ever. But I'm building this database. I'm populating this database. And it's a lot of fun to look at some of these old trades. Okay. So for example, Bitcoin, this is a Bitcoin ETF called BIDO. So if you wanted to long this, but you were afraid of, being in a regular stock position overnight because stop losses don't work overnight, maybe you took an option, or maybe you had a small budget. And so you took an option. Let me explain. Let's say that a person on 10/16/23, where this green arrow is pointing, saw this as breakout and wanted to be bullish on this BIDO. Let's say that they had a small budget and so they couldn't afford to take a long-term option, maybe 6 months or a year out. And so they took a 2-week option instead, where they said, hey, I'm going to buy this $15 call. Okay, you see it right here. It's this top row that expires on 10/27, which is this candle right here. How much would it have cost them? Well, it would have cost them somewhere between 21 cents, which was the bid, and 27 cents, which was the ask. The market price was 24 cents a share. That's, again, $24 real risk. But look what happened. This popped up, and on the 27th, they could have exercised their option to buy $15 BIDO. It was worth $17.11, so they could have made $2.11 gross profit per share, minus the 24 cents per share premium for the option, which gave them a reward to risk of 8.79. And remember that video I did last week talking about turning $500 into $1 million, I said you needed a win rate of around 20 to 25% on a 5-to-1 system. This almost got 9, okay, almost double, which is incredible. So in real world terms, what that means is, again, they risked $24 per contract and could have made $187 per contract. The reason this is really, really important is because think about this. If you have a small budget, let's say you're trading with $2,500. Okay, that's all of your trade fund. Bam. This allows you to risk 1% or less because $24 risk is less than 1%. And now you still control 100 shares of this stock. But if it goes to zero, or if, it goes down 50%, none of that matters. And the beautiful thing is it could even go down and then go right back up. None of it matters. You can't be shaken out, with a quick dip that hits your stop. because you don't have a stop in this example. And this example, a person would literally be risking the premium. Now, there's other ways to do this, and I do have stops sometimes, what's called a soft stop. So, for example, if I was taking this trade and I had $24 risk and suddenly took out this low back here, yeah, I'd probably close it if there was any value left in closing it. Maybe, get back $4 or $6 worth of premium, right? Lighten my loss just a little bit. It would depend on how much I could get back. So it just takes a lot of risk away, and it's very, very affordable to get into. Again, we're talking about this right here, this 10/27 expiration being purchased on 10/16 for 24 cents, or $24 per contract. But just like my other video on options, I will be quick to point out that this is not intended to be a comprehensive video on single leg options. It is an introduction video to how you might look at a single leg or a naked call option. And I highly encourage you to go out there and do more due diligence on your own. Please remember that I am just some guy sitting in a spare bedroom, which means that nothing in this video is financial advice. You should always go out and do your own due diligence and seek out professional financial advice from a licensed financial advisor before making any type of investment in cryptocurrency, the stock market, precious metals, Forex, or any other tradable assets. If you enjoyed the video, give it a thumbs up. Make sure to subscribe to the channel. Of course, leave me a comment. I love hearing feedback. And last but not least, please remember to trade safe.